When you reach retirement age, you'll be able to access 25% of your pension completely tax-free. Although it is worth mentioning that this is limited to 25% of the 22-23 tax year's lifetime allowance, which was normally £1,073,100. The remainder of your pension will be taxed at your marginal rate. Whilst being able to access 25% tax-free is a great benefit, few people actually know all of their options for accessing their tax-free cash, and there are a few major complications you should be aware of as well. It may be that you want to take out a small amount of tax-free cash from your pension at retirement age to maybe buy a car or extend your home. This is of course something you can do. Let's say you had a pension pot of 500,000 and you want to take out 10,000 of tax-free cash to buy a VW Polo for a very lucky grandchild. You need to deem the portion of your money that you want to take 25% of as being in drawdown with your pension provider. So you would simply place 40,000 into drawdown and take your 10,000 of tax-free cash out. Moving the 40,000 into drawdown is simply administrative. You can leave the remaining 30,000 in drawdown and the rest of your pension untouched until you need it. So let's take another example. If you reach retirement age and your pension pot is £400,000, you could choose to access your full tax-free cash entitlement of £100,000. Once you do this though, the remaining 300,000 and any future growth will be subject to income tax when you want to access the money. It will also most likely bring the 100,000 into your estate for inheritance tax purposes, so do bear that in mind. Another possible approach to using tax-free cash is to drip it out over time alongside taxable income. Done effectively, this can reduce the amount of tax you pay each year in retirement. You should be careful when doing this though, as taking taxable income from your pension will trigger the money purchase annual allowance. This will then limit the contributions you can make to your pension to £10,000 a year, so it may not be a great option if you're still working. People often choose to take out a large sum of tax-free cash to pay down what is left of their mortgage. Instead of overpaying their mortgage from their income that is subject to income tax and national insurance, they instead contribute their income to their pension. Contributions to pensions are gross of tax, so they grow their fund at a rapid rate. Once they reach retirement age, they can then use their tax-free cash to pay the remainder of their mortgage down. There's a big but though. As I mentioned earlier, in order to access your full 25% of tax-free cash, you need to move 100% of your pension into drawdown and fully crystallize your pension. With the recent changes to the lifetime allowance rules, this basically means that £1,073,100 will be put into drawdown, and you will be limited to just over £268,000 of tax-free cash. Although this might differ slightly for those who had lifetime allowance protection in place or have pensions with enhanced benefits, so it's definitely worth exploring this with an advisor. The rest of the withdrawals from your pension will be taxed at your marginal rate. You'll also be bringing the £268,275 into your estate, so once again, it's a careful balancing act. Quite simply, it's not always straightforward. If you have a small pension, you do have a number of options, and it's probably not going to be overly challenging to access your tax-free cash. If, on the other hand, you have a reasonably large pension pot, you should probably take some advice before taking withdrawals. Because remember, your money really does matter.